right now as you watch this. Gold is giving you one final entry point before it never looks back. We are sitting at approximately $4,189 per ounce after a sharp $100 pullback from the recent high near $1,400. That pullback is not weakness, it is the gift. The final gift before the move that takes gold to $6,000 and beyond. If you have been waiting on the sidelines, this is the moment the market is testing you. If you are already in, this is the moment you add, because the setup we are in right now has only happened a handful of times in the last 100 years. And every single time the outcome was the same: explosive, relentless, life-changing for those who positioned early. Welcome to Unseen Economy. This is the channel that shows you the real gold market, not the one the financial media wants you to see. If you are new, hit subscribe right now and turn on the bell, because the next 12 months in gold will separate those who understood the cycle from those who watched it on the news. And drop your city and country in the comments. I want to know where the real gold stackers are watching from. Dubai, Singapore, Zurich, New York, Mumbai, London, Toronto. This story belongs to every serious mind on the planet. Let me be direct. Gold at $6,000 is not a prediction. It is the inevitable destination of the monetary reset that is already underway. The only question is how violent the move becomes and how many people get left behind because they waited for more confirmation. Confirmation is what happens after the move is half over. We are still in the setup phase. And this $100 dip is the last time the setup will look this clean. Let me show you exactly why. First, the macro backdrop that makes $6,000 not just possible, but mathematically logical. Global debt now exceeds $400 trillion. That is more than 4 times global GDP. Every major central bank is trapped. They cannot raise rates enough to fight inflation without collapsing their own bond markets and banking systems. They cannot cut rates aggressively without reigniting the very inflation they claim to have defeated. The only escape valve left is currency debasement, and gold is the only asset that cannot be debased. This is not theory. This is what every major central bank on earth is already acting on. In 2023, 2024, and 2025, central banks bought over 1,000 tons of gold per year. That is the highest level of official sector buying in modern history. China, India, Turkey, Poland. Even the Bank of England has quietly stopped selling. They are all doing the same thing, reducing exposure to a dollar system they no longer fully trust. And they are not buying gold because they think it will go up 10%. They are buying because they believe the current monetary order is ending. The BRICS expansion is accelerating this shift. New members are joining. New payment systems are being built. New reserve assets are being accumulated. Gold is the only neutral asset that every nation can agree on. It requires no one's permission. It carries no counterparty risk. It has survived every empire that ever tried to replace it. This is the backdrop. This is why $6,000 is inevitable. Now, let me show you the technical structure that confirms we are still early in this move. Gold has been in a massive ascending channel since the 2020 lows. Every pullback to the lower trend line has been bought aggressively. The current $100 dip has taken us right back to that trend line. This is the highest probability entry we have seen since the breakout above $2,500 in 2024. The measured move from this multi-year base projects a minimum target of $5,800 to $6,200 before the next major consolidation. That is not my opinion. That is simple technical math. But the technicals are only half the story. The real driver is the physical market. And the physical market has never been tighter at this stage of a bull market. COMEX gold registered inventories are at multi-year lows relative to open interest. Lease rates for gold are firming. Physical premiums in Asia remain elevated even as the paper price dips. ETFs have seen steady inflows from institutional buyers who are not chasing short-term trades. They are building strategic positions for the next decade. Meanwhile, mine supply is flat to declining. Major discoveries have dried up. Existing mines are facing declining grades and rising costs. The world is not producing more gold. It is consuming more. This is the classic setup that produced the great gold bull markets of 1970, 1980, and 2009 and 2011. Both times, the price went parabolic once the monetary and physical forces aligned. We are at that alignment point right now. The $100 dip you're seeing is the market's final test. It is flushing out the weak hands who bought the top in January. It is giving the smart money one last chance to add before the real move begins. And make no mistake, the real move will be violent. Gold does not go from $4,800 to $6,000 in a straight line. It goes in waves. But the waves get bigger and faster as the cycle matures. The next leg higher will make the 2024-2025 move look calm by comparison. This is why I'm telling you this $100 dip is your last chance. Because once gold clears $5,000 with conviction, the narrative shifts permanently. Mainstream media will stop calling it a bubble and start calling it a monetary reset. Retail investors will pile in at $5,200, $5,500, and $5,800. The same people who laughed at $2,500 gold will be buying at $5,500 and calling it cheap. That is how these cycles work. The smart money positions during the doubt, the crowd positions during the euphoria. We are still in the doubt phase. This $100 dip is the doubt. And next, I'm going to show you the exact catalysts that will turn this doubt into the biggest moonshot of 2026. The specific central bank buying data that no one is talking about. The gold-silver ratio setup that is screaming for silver to catch up. The one geopolitical trigger that could send gold vertical in a single week. And the precise levels you need to watch to know the move has begun. But before we go there, I want you to do something important. Look at your own situation. How much gold do you own relative to your net worth? Is it 5%? 10%? 0? In every major monetary reset in history, the people who survived and thrived held between 10 and 30% of their wealth in gold. Not because they were gold bugs, because they understood that paper promises eventually get tested. We are at that test right now. The $100 dip is not a reason to wait, it is the reason to act. Drop your thoughts in the comments right now. Are you adding on this dip? What percentage of your portfolio is in gold right now? What is your personal target for gold by the end of 2026? I read every single comment. The dip is here, the setup is complete, the moonshot is loading, the $100 dip is here, the setup is complete. Now let us talk about the exact catalysts that will turn this doubt into the biggest moonshot of 2026. Because the technicals and the macro backdrop are only the foundation. The real accelerants are already in motion. And they are far more powerful than most investors realize. Let me start with the central bank buying that is quietly rewriting the gold market. In 2023, 2024, and 2025, official sector purchases exceeded 1,000 tons per year. That is not a typo. Over 3,000 tons in 3 years, the highest sustained buying in modern history. China alone has added more than 1,200 tons to its official reserves since 2022. India has been a consistent buyer, adding 200 to 300 tons annually. Poland shocked the market by announcing it would increase its gold reserves to 20% of total reserves. Turkey, Hungary, and several Middle Eastern nations have been aggressive accumulators as well. This is not tactical buying. This is strategic repositioning. These institutions are not trying to make a 15% profit. They are preparing for a world where the dollar's reserve status is no longer absolute. And here is what most people miss. When central banks buy gold, they do not buy paper gold on COMEX. They buy physical bars. They take delivery. They store it in their own vaults or in friendly jurisdictions. That metal is removed from the tradable pool permanently. Every ton they buy tightens the physical market for everyone else. This is why the paper price keeps finding support, even during corrections. The official sector is the bid that never goes away. Now let us talk about the gold-silver ratio, because this is one of the most powerful signals in the entire precious metals complex. The gold-silver ratio currently sits around 61 to 1. Historically, during the later stages of bull markets, this ratio compresses dramatically. In 2011, it fell below 40. In 1980, it went under 20. A move back to 50 would imply silver at roughly $96 if gold is at $4,800. A move to 40 would put silver above $120. But the ratio is not just about silver catching up. It is a leading indicator for gold itself. When the ratio starts compressing, it means monetary demand is overwhelming industrial demand. That is exactly what happens in the final, most violent phase of a gold bull market. We are at the beginning of that compression. The ratio has already come down from 90 plus during the 2020 panic. The next leg lower in the ratio will coincide with gold's fastest gains. This is why I keep saying $6,000 is inevitable. Not because of any single catalyst, because multiple powerful forces are aligning at the same time. Central bank buying, monetary debasement, geopolitical fragmentation, physical supply constraints, and now the technical structure that says we are still early. The current $100 dip has taken gold right back to the rising 200-day moving average and the lower trend line of the multi-year channel. This is the same level that produced the explosive moves in 2005, 2009, and 2016. Every time gold tested this zone during a bull market, the subsequent rally was faster and larger than the previous one. We are repeating that pattern right now. Now, let me give you the geopolitical trigger that could turn a steady climb into a vertical explosion. The current US-Iran diplomatic talks are creating short-term relief. Risk assets are breathing easier. The dollar has firmed. Gold has pulled back $100. But here is what the market is not pricing in. Any lasting deal between the US and Iran will eventually require the US to offer concessions. Those concessions almost always involve some form of sanctions relief or financial accommodation. That means more dollars flowing into the global system, more dollars chasing the same amount of goods and assets. In other words, more inflation, more debasement, more reason for the world to own gold. On the other hand, if the talks collapse, we get an immediate risk-off spike. Gold gaps higher $50 or $100 in a single session. Either path leads to the same destination, higher gold prices. The only difference is the speed. This is why I'm telling you this $100 dip is your last real chance. Because the next catalyst, whether it is a failed deal, a new BRICS announcement, or simply the next round of central bank purchases, will not give you another clean entry at these levels. The market is testing your conviction right now. It is offering you one final opportunity to position before the narrative shifts permanently. Once gold clears $5,000 with conviction, the mainstream will finally admit what the data has been saying for years. This is not a cyclical bull market. This is a monetary regime change. And regime changes do not happen at 5% or 10% gains. They happen at 50%, 80%, and 100% gains. From $4,800 to $6,000 is only 25%. That is still early. That is still the setup phase. The real moonshot comes after $6,000, when the ratio compresses, when the short covering begins, when the retail crowd finally wakes up. But you do not have to wait for that phase to profit. You just have to survive the current test. The $100 dip is the test. And next I'm going to show you the precise risks that could delay the move, the exact price levels that confirm the moonshot has begun, and the actionable steps for physical buyers, miners, and paper traders. I will also give you the one data point that would make me change my entire outlook. But before we go there, I want you to ask yourself one honest question. If gold goes to $6,000 in the next 18 months, will you look back at this $100 dip as the moment you acted, or the moment you hesitated? The dip is here, the catalysts are aligned. Now let us talk about the risks that could delay the moonshot, and why none of them change the inevitable destination of $6,000 gold. Because only the weak ignore risk. The strong face it, plan for it, and position anyway. The first risk is the one everyone fears but almost never happens at this stage of the cycle. A stronger dollar. Yes, the dollar can rally. It can rally for weeks or even months on the back of better US data or geopolitical relief. We are seeing a small version of that right now with the US-Iran talks. But here is what history shows. In every major gold bull market since 1971, the dollar has had multiple 10 to 15% rallies. Every single one of them was bought aggressively by the smart money, because the underlying drivers of gold, debt, debasement, and de-dollarization do not disappear just because the dollar has a good month. A stronger dollar delays the move, it does not kill it. The second risk is manipulation. The paper market still has power. Large banks can still push gold lower on low volume days or during options expiration. We may see another $80 or $100 smash before this leg is over. But here's the difference between now and 2013. In 2013, the physical market was not tight. Central banks were net sellers. Mine supply was rising. Today, the opposite is true on every count. Every smash attempt removes more metal from the system and hands it to stronger hands. The COMEX can still move the paper price. It can no longer move the physical reality. The third risk is time. $6,000 may not happen in 2026. It could slip into early 2027 if the dollar stays strong longer than expected, or if a major risk event is avoided. That is the realistic bear case, not lower prices, just slower timing. Even in that scenario, the technical structure and the monetary drivers remain intact. The only thing that changes is the calendar. Now, let me give you the exact price levels that will confirm the moonshot has officially begun. The first and most important level is $4,120 to $4,950. That is the recent high and the upper boundary of the current consolidation. A decisive weekly close above $4,150 with expanding volume is the signal that the $100 dip is over and the next leg higher has started. The second level is $5,200. This is the measured move target from the current base. Breaking and holding above $5,200 will trigger algorithmic buying and short covering that will feel violent to anyone who is not positioned. The third level is $5,500. This is the psychological and technical inflection point. Above $5,500, the mainstream narrative shifts from gold is expensive to gold is cheap relative to the monetary reset. That is when retail inflows become a flood. And finally, $6,000 itself. This is the level where the gold-silver ratio compression becomes self-reinforcing. It is the level where central banks that have been buying quietly start buying more aggressively because they see the writing on the wall. It is the level where the moonshot phase truly begins. These levels are not random. They are the roadmap. Now let me give you the one data point that would make me change my entire outlook. If the People's Bank of China or the Reserve Bank of India announced they were pausing gold purchases for 12 months or more, I would have to reassess the timeline. Not the direction, the timeline. Because those two institutions have been the most consistent and aggressive buyers of the past 3 years. If they step back, it would mean either they have reached their target allocation or they see a different path forward. That is the only data point that would make me pause. Everything else, stronger dollar, manipulation attempts, diplomatic deals, is noise. Now let us talk about what you should actually do with this information. If you are a physical buyer, your strategy is simple and timeless. Buy the dip. Buy allocated metal. Buy from reputable dealers with transparent storage. Do not try to time the exact bottom of this $100 move. The difference between buying at $4,189 and buying at $4,689 is meaningless compared to the difference between buying now and buying at $5,500. If you're looking at gold miners, focus on the highest quality names with clean balance sheets, low all-in sustaining costs, and proven management. The leverage in quality miners on a move from $4,800 to $6,000 is 4x to 7x. That is where the real wealth creation happens in this cycle. Avoid the high cost, high debt names that will get crushed if the dollar stays strong longer than expected. If you are a paper trader or options player, the game has changed. The breakout above $4,950 is your trigger. Until then, keep position sizes small and respect the invalidation level at $4,650. The asymmetry is still heavily skewed to the upside, but the volatility will increase as we approach $5,200. Size accordingly. The most important thing is not which vehicle you choose. It is that you choose something. Because sitting in cash while the monetary reset unfolds is the highest risk decision you can make. Let me bring this entire series to a close with one final thought. In every major monetary regime change in history, there comes a moment when the old system looks invincible and the new system looks impossible. We are at that moment right now. The dollar still feels dominant. Gold still feels expensive to the average investor. The mainstream still calls this a bubble, but the data tells a different story. Central banks are voting with their reserves. Physical metal is leaving the system. Debt is growing faster than GDP. Trust in paper promises is eroding. $6,000 gold is not a prediction. The $100 dip you are seeing today is the market's final gift to those who have done the work. You now have the information. You now have the levels. You now have the roadmap. What you do with it is up to you. Drop your final thoughts in the comments right now. Are you adding on this dip? What is your target for gold by the end of 2027? What is the one thing you learned from this series that changed how you think about gold? I read every single comment. If this series gave you clarity and conviction, hit like and subscribe. Turn on notifications so you do not miss the follow-up when we break 4,250. Because that moment will come faster than most people expect. The dip is real. The setup is complete. The moonshot is inevitable. Gold at $6,000 is not a question of if. It is only a question of when. And the when is closer than you think. Stay sharp. Stay positioned. It leads.